Here's a three-column cash book. On March 1, the bank column of his cash book showed a debit balance brought down of 2,750. The following transaction took place in March 2017. So we have a cash book for Amjad already, which is stating March 1, balance brought down, balance is brought down. Balance brought down, we have 38, and for the cash, we have 2,750 for the bank. Sorry. For the cash, 38, and there's a bank balance, which was stated here. From the bank, balance brought down to 2,750. This balance brought down could be the bank overdraft from the previous month. Do you understand? It could be what? A bank overdraft by Amjad from his bank from the previous month. So that balance will be brought to this account. But since it is a debit balance, it is not a credit balance. If it was to be a credit balance, it would be an overdraft. But because it's a debit balance, it means the amount of money he has left in the bank. Do you understand the difference here? Yes. If it was an overdraft, it would be a credit balance. Do you understand? But what this means is that Amjad has a certain amount of money in the. So, because he said it's a debit balance, it means Amjad has this amount of money in his bank account. I think that is clear. So he has this in bank and he has this amount in cash. That is clear, right? Okay, great. Now, we have the following transaction that took place in March. Paid 950 by check. This included 790 for a new computer system and balance was for repairs of existing office equipment. So, two transactions are there. He paid for the office equipment and he pays for the repair of office equipment. Do we get it? Mm-hmm. So, for the office equipment, we have 950 by check, right? 950 by check. 950. Where 790 goes for the office equipment. And the rest, that means 790. Office equipment, a check from the that's bank, right? 950. This was for the office equipment minus this amount will be for repairs. Repairs of this. Do you understand? So this will be what? 050 minus 9. 6. Then it remains 9. 9 minus 8 minus 7, 160. So on your debit side, on your credit side here, in the cash book, in the three-column cash book, you're going to have your office equipment, which was paid for at 790, and the repairs, which was what? 160. Makes up for that bank. Is it clear? Is it clear, please? Yeah. So now we write March 1. March 6, right?
March 6, yeah.
March 6. Office equipment. Office equipment. And short it like that.
160.
Bank. That's 790. Is it clear?
Yes.
So for the repairs now, the same date, right?
So repairs is 160.
Repairs of equipment. 160. I think that's clear.
Yes.
Great. Then we move on. On what else do we have? On March 13, received a check from XY Limited for 196 to settle its account after deducting 2% cash discount. So 196 was received, but Amjad has given a discount to XY Limited. So that means on the debit side of the cash book, you're going to have the discount allowed and the amount of discount taken away. Is it clear? So please let me check the discounts now. For XY, we have 2%, right? We have 196 multiplied by 2%. This is 196 multiplied by 2% is for 2 divided by 100 is 0.2 or what? 0.02. Please do that for me, please. is 0.02 multiplied by 196. 3.92.
So minus it from the 196, right?
Yeah, minus 196, yeah.
192.8.
One what?
192.8.
192.8. Is 08. Okay? So let's check it inside. Receive the check of 196 to settle its account. It does a 2% cash discount. Okay, that's how much? The total is, for the discount allowed. So right, March 13, right?
Yes.
March 13, XY Limited. So how much is it? One call it for me again. The total discount allowed 3.92, right? 3.92, okay.
Total is 192.08.
192, 192.08,
Yes.
08, okay. That's for XY Limited. Then we move on. The next account was March 21. What happens in March 21? Paid furniture store, a check of 351 in full settlement of a balance owing 360. So there's a cash discount also. There's a discount here. So on the 21, March 21. March 21. Furniture store, right? Furniture store. 351 for 360 that was supposed to pay. So discount received from furniture store of 9. Discount received 9. For furniture store for how much? 351. 351. Are you guys getting it?
Yes.
Alright, we move on. So on what is the next one? On the 29th, made cash sales of 2148. So on the 29th, there's a cash sales for 2,148. 148 cash. 2,148. Is it clear? One. So we move on. What else do we have on the 30th? Paid cash. Can you just stop these things and look focus here? On the 30th, we have cash. They said on the 30th, paid cash into bank. Paid cash into bank. So that means there's a contract entry. Cash paid to bank. That's the contract entry. Are you with me? So that means here, what we're going to have here on the what? On the 30th. Cash paid into bank. Contract entry. Bank, how much is that? 2,000. Do you understand now? Paid cash into bank. Cash was paid into the bank. Bank received the cash. So that makes it a contract entry. Money doesn't go out of the business. It's still within the business. Do we get it? Great. Then what else do we have there? So let's stop for there. Now let's go to. Okay. Now let's write our contract entry for this. March 30, which is how much? 30 bank. Contract. 2,000. No, cash, sorry. Cash to bank. Okay, yeah. Cash to bank. Contract. 2,000, yeah. 2,000. So what else do we have there? So that's all about that. Then we check the additional information. They said Anker received bank statements will have not been recorded in his accounting records. Bank charges, insurance paid directly by the bank, a credit customer entries are paid his account by credit transfer 474. So there's an expense. So this is an expenses. Bank charges and expenses. Insurance paid directly by the bank. It's also going to be on the credit side of the cash book. Then a credit customer Idris had paid what he is owing, which is what 474. So we write on which day? On the 31st. On the 30th. So we have on the 30th. What do we have? Bank charges. Charges. How much is that? 29. 29, okay. Insurance on the 30th again. Insurance 50. Then it said Idris paid 474, right? So it's in the Idris on the 30th. Idris paid 474. A credit transfer, which is a bank transaction. 474. Is it clear to you? Do you have any questions for now? No, please add it together for me now. Sit down properly, I said.
The cash is gonna be
2,186.
What?
2,186.
2186.
Yes.
So, yeah, let's say,
For bank,
hold on, please. All right. 2186. 2186, right? 2186. So this is 2186. Here we have 2000 as cash, right?
yes,
So we're going to have balance carry down 186, right?
yes.
186. So this gives us 2186. So we check the next one.
Mr. Bank,
On the back,
5,460.
5,000.
460.048.
5,460.
16.
16.
16.
You want to say something now?
I know, I'm trying to put it in the bank.
Okay. 416.08.
.08. Yes.
Okay. So this is more than this, right?
yes, the other one is 1,380.
So now take this away from what you get here. What does it give to you?
54,000.
5,416.
Ah, that's what I want. 4,036.08.
4,000.
36.08.
4,036.08, right?
Yes.
Okay, so it gives you 5416.08. Is it clear?
Yes.
Alright. So but then our discount 9 and discount here 3.92. So this is March, this is for 20 what? 2017. 2017. So we write balance here. So, that's the end of March. This is end of March. So we have 2017 again. April 1. April 1. Balance brought down. For cash, how much? 186. Do you understand? And for bank, 4036.08. Is it clear? So the next question says, that's the balance for that. The next question. They said, explain why Amjad should consider the following when he's looking at the financial statement of other businesses. Historical cost. I explained historical cost in the last class. I told you about stock items. We said historical cost is what? The amount, the financial value, the amount, the value of whatever assets or whatever items you buy, the actual value of that item must first be registered. So if you buy, this is an asset, let's say you buy a motor vehicle for $3,000. So this is the historical cost. If whatever happens afterwards, then maybe there's the net realizable value, NRV, or depreciation. So whatever happens, this is the first record of this. This is the first value of that amount. So this is what we call historical record. Writing the actual, knowing the actual figure of whatever item you bought. That's what I mean by historical value, historical figure, or historical cost. Then talk about non-financial aspects. I told you, what is non-financial aspect? The record must only be whatever records you do in terms of accounting, it must have a monetary value. Whatever you have to record in your accounting, your financial statements, or in any of the accounting records, whatever accounting records you need to do, it must have what? Monetary measurements.
Or value.
Yeah, monetary value. It must have a monetary value or monetary measurement.
So measure of value.
It must be in monetary terms. Whatever you need to be in records. All these things are monetary terms. They are monetary. They are money measurements. It's not just something. It has figures. Then the question 2, they said, name the source document which Aaron would use to record the following. Sold goods on credit to Cargill. When you sell goods on credit, you give an invoice. Your credit customer, what does a credit customer have? You give your credit customer a sales invoice, an invoice. They ask, which documents? Documents. Cargill returns goods. When your credit customer returns goods to you, what will you give? Credit note. He would have given you a debit note. Yes or no? Then you give a credit note to say, okay, yes, this amount of money will be deducted, will be given back to your account.
I think I wrote something, debit something.
I don't know what you wrote. I didn't check. And now they said, name the book of planned original entry which Aaron would record the following. For Aaron,
Could you show us?
is here. Question what? Question 2. Name the source documents which Aaron would use to record the following documents. First, sold goods to credit. When you sell goods to your customer, he did not pay, the customer didn't pay yet. You give an invoice, a sales invoice. Not just invoice, a sales invoice. You receive purchases invoice whenever you bought from your suppliers without paying. Now, Cargill returned goods. Cargill would have given a credit note to Aaron to say, oh, I am returning these goods. Then Aaron would issue a credit note to say that that amount payable would have been deducted from Cargill's account. They said, name the book of prime original entry in which Aaron would record the following. The bank returned Calvin's check. When they return your check, you gave a check, dishonored check. A dishonored check will be in your cash book.
External.
Dishonored check. Dishonored check. It will be in your cash book, the credit side, the debit side of your cash book, dishonored check. You issue the check to a customer or to a supplier, and the bank didn't pay the supplier. That means the check will return to you. If the bank paid the supplier, it will be payment here, bank. But because you received back the check, it will nullify here. The check paid here. The check returned here. There was no payment. So your debit entry for dishonored check will nullify the credit you made for that check that has been given to maybe furniture stores. So dishonored check goes to your cash book on that bank. Now they said the balance of Calvin's account was written off. Bad debt written off. That's the general journal. Remember we said whenever account doesn't have names, instead of you to start opening different ledgers or different journals, just open a general journal to put account of minute transaction. They are your customers. You have different customers. So you want to be opening one account, one journal for each customer? No. You have a journal for the customer, then you put their names there. You don't open each journal for customers. You open a general journal. So that whichever customer comes to you, you put their name into the general journal. I think it's clear. I think it's clear. Now, here they said, name 4 objectives of Aaron should apply. 4 objectives Aaron should apply. The first one has been completed. We're talking about accounting records. We're talking about accounting principles, conventions and concepts. We did that in the last class. Accounting objectives, concepts and conventions, accounting policies. They gave you relevance. Then what are the other ones? Reliability, understandability, comparability. These are things you put into records before you have to compare 2 accounts. These are the things you have to put into record. What are your objectives as an accountant? Then they said, suggest 2 ways in which the profit of the year could be increased. How can you increase the profit of your year? You want to increase it as a business. Let's forget about accounting terms now. Your common sense. As a business, how can you increase your profit? How? The first thing you have to do to increase your profit is to reduce your expenses. Yes or no?
Yes, yes.
You want to increase your profit, you reduce your expenses. In the course of you reducing your expenses, then you can make more profit. Another way to increase your profit is to increase your incomes, the amount of money that comes to your business. You increase your incomes. You reduce your expenses, you increase your incomes. You want more profit, right? How do you make profit? It's not with the money that comes to your business. So money that comes to your business, find other ways of increasing the money that comes to your business. By that way, you increase your income. That is how you can make more profits. Spend less. Reduce your expenses. You can also increase your profit margin. These are the only ways you can. These are the ways you can increase your profit as a firm. They said, how do you increase your profit? How? I saw different answers like you guys are just giving. I don't know how. It was only, I think some of you got it right anyway.
That's with expenses.
I think there's one more, right? 4G. Yeah, he said, suggest 2 ways in which partners could increase the working capital. What's the working capital? The head of the balance you have there, the capital that is left. How do you increase that capital? The amount of money that you use to continue to run the business. You reduce your drawings. Have you forgotten that drawing is part of what you take away from your capital? In your statement of financial position. In your statement of financial position, you less drawing, yes or no? So, how do you increase this capital? By ensuring that you don't withdraw more. Then the capital, working capital will increase. Because whenever you withdraw, it is a drawing. So the drawing will be taken away from the capital. That's the working capital. Your total asset minus your total liability gives you your working capital. So how do you increase this working capital? By not taking so much from the business. Yes or no? We have capital. In your statement of financial position, you said capital, less drawings, right? Add profits. Is it not how it is in your statement of financial position? Now they said, how do you increase this? To increase this, you stop this. To increase this, you add more of this. This will reduce your capital. So you stop withdrawing, you stop your drawing, you will reduce your drawings. This will add more to your working capital, yes or no? Because this is a retained profit. The profit put into the business. When you put more profit into the business, does it increase the capital or not?
Yes, it does.
So the question says, how can you increase this? To increase this, you stop this. Because this will always reduce your capital. To increase this, you add more to this. How do you add more to this? Reducing your expenses, increasing your incomes, increasing your profit margin. It goes back to the first question, which says, how can you increase your profits? If you are able to increase your profits, you'll be able to increase your working capital. Then, I said now, if you are able to increase your profits, you'll be able to increase your working capital. So how do you increase your profit? So it started from your income statement. Reduce your expenses. When you're able to reduce your expenses, it increases your income. And as a result of that, your profit will increase. So for profit to increase your incomes, reduce your expenses. Now, going to your working capital. For your working capital to increase, reduce your drawings and add more profits. Drawing is not the same as expenses. Drawing is the money taken by the owner of the business from the capital. Because when the owner of the business gives money to the business, it's capital. When the owner of the business takes money from the business, it becomes drawings. When the business spends a certain amount of money for the business purpose, it is an expenses. When the business sells, it receives income or revenue. I think it's there.
Yes.
And also another way to increase your capital is to take a long-term loan.
Long-term loan.
Long-term loan. Not a short-term loan like overdraft. Because when you take an overdraft, you have to pay back within 6 months. But when you're talking about a long-term loan, it takes more than years to pay. You will be paying the interest, yes. But the loan is still there. So it allows you to have more working capital. That's why I said it's capital plus liabilities. So the loan you take, you are putting it into the business to increase your working capital, a long-term loan. So you'll be able to use the money now, even for the future. So I gave you 3 ways in which the capital, the working capital of a business can increase. 1, reduce your drawings. 2, increase your profits. And how do you increase your profits? Spend less, increase your incomes. And the third one,
Reduce expenses.
reduce your expenses. Yeah, reduce your expenses will help your profits. And the last one is take a long-term loan, not a short-term. You can write.